Let me now bring on board Parul, Senior Director RBS, joins us live from Singapore. Parul, I have with me in my hand your India Strategy Report dated 10th of Jan, and my compliments, Parul. You got the call right. The first line of the strategy report is that at RBS we are bullish on India and we expect Indian markets to appreciate by 25% in the calendar year 2012. Great call, you were on the button. But now that Indian markets have appreciated by 22%, what will you advise our viewers, or what will you or what are you advising your clients?
Good morning, Nikunj. Thanks for pointing that out. I appreciate that. What we are telling clients right now that even post the move, actually, I think we should be buying Indian equities because our view is that although we've had the sharp move up from the lows, what we've seen year to date, or the sharp up move from December lows, a lot of it is essentially a reversal of what we saw from late October to 20th December when the market as a whole fell around 15%. And so if you compare the market now to late October, we're only around 5% above October levels. Valuations are roughly similar at around 14 times forward earnings. And I would make the case that fundamentals are actually a lot better in quite a few instances. Globally, I think if you look at the US, the risk of a double-digit recession has significantly reduced. In Europe, with the LTRO, I think the risk of financial crisis is also down quite significantly. And in India specifically, we've had a number of positive developments over the past 3 months or so. Firstly, of course, monetary policy has turned more growth-friendly.
After a 22% appreciation and approximately 30-35% appreciation in rate sensitives, what worries you most about the existing India setup?
Sure. But just wanted to complete my answer to the question before we started talking about specific stocks. I think things are different, have improved from October. So even if you look at the rate-sensitive stocks, which have rallied quite significantly from the lows, most are only slightly above where they were back in late October levels. And you could make the case that monetary policy now is actually significantly different than what it was in late October. We're definitely in a more growth-friendly monetary policy. And the January WPI inflation data was significantly better than expected, especially on the core manufacturing inflation side. So you would have more confidence that policy rate cuts of around 125 basis points will come through. In addition, in the rate sensitive, especially the banks, asset quality hasn't deteriorated as much as the bears were expecting. So if you look at the stock of total stressed assets, which is gross NPLs plus restructured loans, that stayed flattish at around 6.4% of the loan book in the December quarter versus the September quarter. I think the bearish consensus was that these numbers are going to go as high as 10-12% within the next 12 to 18 months. And these results seem to suggest that, okay, things are bad, but they're not as bad as the bearish consensus is expecting. So I think part of the rally, of course, liquidity has helped, but I do want to make the point that fundamentals have also improved on the margin. Of course, if you are investing in rate-sensitive stocks, there will be risks. The risks, of course, are of a further deterioration in asset quality, something more than what we are expecting currently. And two, of course, that the rate cuts that we are forecasting do not come through, or they're slower than what we are expecting. From our perspective, those would be the two kind of key risks. One risk which I think could play out, but I don't think may move stocks that much, is also these recommendations that have been put out on priority sector lending. Because I do think they will. They are supposed to encourage private sector banks to do a lot of priority sector lending on their own rather than go through NBFCs, and that may prove a bit challenging for some of the private sector banks.
Parul, you just talked about interest rates easing off. Would it be fair to assume then that the next leg of the rally also the drivers would be the rate sensitives, largely financials, autos, as well as real estate?
Yes, from a top-down perspective, that's what we are still recommending. We are recommending the rate-sensitive names, specifically the banks. So ICICI Bank, Canara Bank, and Power Finance are our top picks. Also strongly recommending Maruti, because we think that's sales are much more rate-sensitive than the two-wheelers. On real estate, though, we are not as positive because if you look at the leading player there, DLF, from a strategy perspective, top-down perspective, we still think it's probably a bit rich. The banks had gotten beaten down quite significantly and had come down to below average valuations. The real estate name, something like DLF, is still quite rich, both relative to its own history and relative to the region. So we are playing banks and the auto stocks, real estate, we're still holding on for now.
Parul, also in your last strategy report, you've made a case to go underweight on telecom, and that call so far has worked. But now that a lot of clutter has been cleared in the telecom sector after the Supreme Court verdict, is it time to go overweight in telecoms? We are actually still recommending that clients be underweight telcos. Of course, I think one aspect of investing, if you're investing in the stocks, is what's happening on the regulatory side, which you could see on the margin with the 2G decision. Competition will come off because some of these licenses have been recalled. But I think what we are more concerned about is what could potentially happen to the competitive dynamics in the business with the entry of Reliance Industries. Because the analyst thinks that the evolution of the 4G standard LTE, which Reliance Industries is planning to roll out, has been a lot faster than what most people were expecting. So that could potentially lead to a scenario where Reliance Industries offers data services and bundles voice, which could be a significant competitive threat to the incumbents, specifically Bharti and Idea.
Parul, you just talked about the RBI stance. What about the budget? Can we expect a lot of policy action by the government this budget?
I think at the beginning of the year, even if you didn't get much out of the budget, I think the market may have responded positively. But given that we've had a strong move year to date, I think investors are probably looking for some more from the budget, so to speak. So I think the starting point should be a credible number for growth as to what the government is using in its budget projections. Last year, if you remember, for the FY12 estimate, the government took a 9% growth number, which looked too high to begin with. And the budget deficit estimate that came up with 4.6% was too optimistic to begin with. So I think this year, the starting point is something credible, say growth number around 7.3%. And with some slight tinkering of tax rates that they're able to present and controlling some expenditures, especially on the subsidy side, if they come up with a budget deficit of around 5.2, 5.3%, I think that'll send a decent signal to markets that yes, fiscal consolidation is taking place, and it is based on credible numbers. It's not based on some aggressive, optimistic assumptions. In terms of policy, I think one thing that could come through is essentially on the subsidies front, what happens to retail fuel prices. I think that could come with the budget itself or shortly after the budget, which will help the fiscal deficit and the under-recovery bill. What we are also expecting is hopefully, as the government has been pointing, that maybe they follow up on the 51% FDI and multi-brand retail. But also I think you have to, I think incremental measures might continue irrespective of the budget. So you had the Prime Minister's office start focusing on what's happening with the issues in the power sector. If those things keep continuing, either as part of the budget or around the budget, which shows that the government is keen to kickstart investment momentum in the country, I think that'll lend support to the market.
Parul, what spooked Indian markets in 2011 was high inflation, high crude prices, policy paralysis, and a high ballooning subsidy burden. Crude prices are at a 9-month high. Can Indian markets ignore crude prices?
If you look at, if you go back to the report we published in Jan 20th, where we laid out a bullish case, we did highlight that crude is a risk, and we laid out sensitivities. And why is it a risk? One, it hits the fiscal deficit, and two, it hits the current account deficit. So the base case we took for crude oil for this year was $110 Brent. $110 for the Indian crude oil basket, which is a blend of Brent and Middle Eastern crudes. And for the FX rate we were using, 52.5. So of course, Brent has moved a lot higher, roughly by around $10. but I think the currency has also come off just a bit. So versus our base case, there's a bit of a slippage, but not as much as to unnecessarily concern us or so to speak, derail the rally. That said, if crude continues to trudge higher, that will be a risk, and we need to keep a watchful eye on that. One thing that could reduce the risk to the fiscal deficit specifically is if the government goes ahead and raises retail fuel prices.
Parul, again, if I revisit your strategy report, your top ideas on 10th of Jan 2012 were ICICI Bank, Power Finance Corporation, Maruti Suzuki and Hindalco. Hypothetically, if you have to write a fresh strategy report today for next 12 to 18 months, what will that contain?
Actually, it will contain many of the same stocks. So we have not changed our model portfolio. Our key picks still, as we discussed earlier, I think we expect financials and banks to continue leading the rally. So the key picks still for us are ICICI Bank, Canara Bank, Power Finance. We like Hindalco and Larsen & Toubro too, and Maruti still. So those names are pretty much the same. I think too early to go defensive or change portfolio positioning right now. I know these stocks have done quite well, but just we have to put it in perspective. Stock like an ICICI Bank is actually back to levels it last saw in October, and you could make the case that monetary policy cycle has turned, and asset quality is actually turning out to be better than what people were expecting. So I do think the moves, strong year-to-date moves, have to be put into perspective as to what the market also did between October and December. And so net-net, yeah, our portfolio positioning is staying pretty much the same.
Parul, several market watchers are now shifting their Sensex year-end targets upwards of 20,000, as high as 22,000 as well. Would you stick your neck out and give us a number?
So our Nifty target at the beginning of the year, which is one of the highest on the street, was 5,800. Of course, that looks quite conservative now. But what I would like to highlight is that was based on a forward earnings multiple of around 13.3 times earnings. Even if you assume by the end of the year the market is trading at the historical average, which is around 14.2 times, you could see the market Nifty at 6,200 by the end of the year. And you could additionally make the case that when monetary policy is actually is more growth supportive and rates are being lowered, you could probably see upside to that multiple also. So I do think there is upside risk to our published price targets right now.
Parul, final question. Right after this interview, if you get a call from your client and his submission is that, Parul, I've missed the rally, what should I do now? How would you answer that query?
I think that always depends upon the client you are talking to and their specific investment mandate. So I do think if you miss the rally, I still think it's not too late to participate. It will depend upon the time frame of the investor per se, but the message we're still going out to investors is don't get too concerned that the market is up 22% year to date. Look at it's hardly done much since October of last year. Valuations are still at reasonable levels, close to historical averages. The monetary policy cycle is turning, which should be supportive for equities generally, and growth is recovering. And so, yeah, you should be a buyer of Indian equities right now.